The article argues that persistent dollar overvaluation, driven by global demand for U.S. reserve assets, has eroded U.S. manufacturing. To fix this, it recommends tariffs and currency policy as tools to reindustrialize the economy and rebalance trade. At first glance, it sounds reasonable, but the argument depends on flawed assumptions. First, it blames overvaluation solely on reserve demand, ignoring factors like interest rates, global risk appetite, and fiscal excess. Second, it misrepresents tariffs as non-inflationary taxes paid by foreigners. In reality, Americans foot the bill directly through higher prices. The essay assumes that America can coerce allies and rivals into new trade terms through tariff threats, but the U.S. only accounts for 9.6% of global exports, hardly enough to dictate terms to the other 90%. Trade partners are already diversifying away from U.S. supply chain. Yes, reserve currency status is a burden, but it comes with benefits, cheaper borrowing costs, financial clout, and global influence. The author glosses over these advantages. The piece leans heavily on the 2018-2019 China-U.S. trade war to support its case. That is a narrow window of time. Markets were erratic, and this is no foundation for long-term economic strategy. Other proposals, like user fees on foreign-held U.S. debt or currency interventions, resemble tactics of failing regimes, not market economies. The U.S. Exchange Stabilization Fund is minuscule compared to the $7 trillion traded daily in FX markets. It cannot meaningfully influence the dollar value. The article promotes tariffs as revenue tools and negotiation leverage. But tariff pain is immediate, while trade agreements take years. Will people accept sustained pain for uncertain gains in the future? No. The Fed is expected to quietly support these plans. Why? By the author's own admission, the strategies have never been tried at scale, anywhere. Nowhere does the author address the main issue: America's massive deficits, nearing 7% of GDP. That's the elephant in the room. Finally, the idea that all bilateral trade should balance with each country is wrong. Trade imbalances are normal. Countries differ in resources, consumption, and capital flows. In the end, the article is a partisan playbook disguised as economic analysis. It favors control over cooperation and gimmicks over sound policy. It may sell well politically, but it's weak economics. This said, the author raises systemic imbalances on non-tariff restrictions and inconsistencies in trade agreements. Yes, those are real and difficult issues. They must be minimized through collaborative multinational action, but not tariff threats.